Okay, let's unpack this. We are diving deep into the recent Deckers Brands earnings call.
Yep.
Our mission today is really to cut through the noise, understand their performance, look at the road ahead according to management, and figure out what all this might mean for you.
Exactly.
Whether you follow Deckers or, just the retail sector generally.
Think of it like getting the key takeaways, right? To still down, we'll hit the numbers, sure, but also the why behind them, the strategies.
And fiscal year 2025 sounds like it was, well, a blockbuster year for them, finished really strong.
Oh, absolutely. Record numbers. For the full fiscal year, revenue came in just shy of $5 billion. That's a 16% jump from the year before.
16% at that scale. Wow.
And profitability kept pace, too. They saw some really nice margin expansion. Gross margin was up 230 basis points, so 2.3%, hitting 57.9%.
Okay.
And operating margin also climbed 200 basis points to 23.6%.
Those are some serious margin gains.
Yeah.
And I guess that all flowed down to the bottom line.
It sure did. Diluted earnings per share saw a huge 30% increase, landed at $6.33 for the year.
30% jump in EPS.
Okay. And
they finished strong too, right? The last quarter wasn't weak.
No, not at all. Q4 closed out solid. Revenue was $1.02 billion, up 6% year over year.
Right.
And Q4 diluted EPS hit $1, which was a nice 22% bump from $11.82 the year before, once you adjust for the stock split, of course.
So, yeah, clearly ended the year with real momentum.
Definitely.
And it sounds like FY25 wasn't just a fluke either. Management seemed keen to point out this is part of a longer pattern.
That's right, yeah. They talked about the last 5 years, calling it, exceptional performance. Over that stretch, revenue grew at a compound annual growth rate, a CAGR of 19%.
19% CAGR over 5 years.
Think about it. HOKA alone added about $1.9 billion in revenue in 5 years.
Just HOKA.
Just HOKA. And UGG added another billion.
That's massive scale added by just those two brands.
Totally. And at the same time, they massively boosted profitability. Gross margin up 600 basis points, operating margin up 750 basis points over those 5 years.
Wow.
Which drove a 32% EPS CAGR. It's a pretty powerful track record, growth and efficiency.
Okay, so that's the rearview mirror looks pretty good. But looking forward, things get a bit fuzzier, mostly external stuff.
Yeah, that's the story. The big cloud is the shifting U.S. trade policy, specifically tariffs. That's shaping up to be a major headwind for fiscal 26.
How big a headwind are we talking? Did they put a number on it?
They did. Based on how things stand right now, they're bracing for potentially up to $150 million increase to their cost of goods sold.
Oof, $150 million. That's significant. Are they just going to eat that, or do they have plans to, fight back?
They're definitely looking at ways to mitigate it. The main things they talked about were strategic price increases in the U.S., selective staggered ones, and also trying to negotiate some cost sharing with their factory partners.
Okay, push some cost to consumers, share some with suppliers. Makes sense. But they weren't saying that it'll completely cancel out the hit, were they?
No, they were pretty clear on that. These efforts are not expected to fully offset that $150 million cost increase in FY26.
Right.
And on top of that, there's the risk of, demand erosion, prices go up, maybe people buy less. Combine that with maybe some general softness in consumer spending. It adds another layer of what if.
It's interesting about their sourcing, though. You mentioned less than 5% from China. Mostly Vietnam.
Yeah, vast majority is Southeast Asia, primarily Vietnam.
Does that help them dodge some of this tariff stuff?
Well, it certainly helps compared to companies heavily reliant on China, no doubt. But that $150 million impact shows that even with diversified sourcing, global trade policies can still bite, maybe through components or broader category impacts.
Okay, so tariffs are the big unknown. But let's get back to what drove that great FY25, the brands. HOKA first. What's the story there?
HOKA just kept rolling. FY25 revenue hit $2.2 billion, up 24%.
24%?
Yeah. And it was strong everywhere. Wholesale up 24%. Direct to consumer, their DTC channel, up 23%.
That's incredible growth for a brand that big already. Where's it coming from geographically?
International was really on fire, up 39%. International is now 34% of HOKA's total global revenue.
Okay, so growing faster outside the U.S.
Definitely. The U.S. still grew a healthy 17%, but yeah, international's pacing faster.
And a lot of this comes down to just more people knowing about HOKA, right? Brand awareness.
Absolutely. They flagged big jumps there. U.S. awareness is now at 50%. That's up 25 points from last year.
Wow. half the U.S. market aware.
And internationally, the average is around 30%, but that's up 20 points. So they're really getting the name out through, global investments, putting the shoes in more places, and just constant product innovation.
Yeah, they mentioned things like opening actual stores, like that Shanghai Experience Center, and campaigns like Everybody Bondi. Feels like they're being smart about getting in front of people.
They are, and the product's key, right? Keeping people interested once they find the brand. They talked about new tech, new materials, refreshing the big sellers like Bondi and Clifton, launching new stuff too. They actually have 5 different HOKA product lines now that each do over $100 million globally.
What's really interesting with HOKA, though, is how people are using them.
Yeah.
It's not just for hardcore running anymore.
Exactly. Management specifically called that out. More people using them for walking, just everyday comfort, lifestyle wear, general fitness. It broadens the audience way beyond just runners.
And they're using that wider appeal strategically, expanding where you can buy them.
Yes, especially in the US, they're leaning more into wholesale distribution now. They see this higher awareness as a chance to use retail partners to grab new customers, people discovering HOKA while shopping in a store.
Does pushing into wholesale potentially cannibalize their own direct sales short term?
It can, yeah. It can put some near-term pressure on US DTC as people might buy through those new wholesale doors. Plus, they mentioned things like, higher promotions on older models clearing out and just general macro uncertainty hitting new customer acquisition. That caused a bit of a slowdown in US DTC for HOKA in Q4.
Okay.
But management sounded confident about keeping existing customers, and they expect things to improve after Q1. But yeah, the big percentage growth drivers for HOKA near term, definitely looking international, aiming for more regional balance long term.
Okay, makes sense. Let's switch to the other powerhouse, UGG, also a strong FY25 for them.
It was indeed. UGG brought in $2.5 billion in revenue, up 13%.
13% growth, still very solid.
Very solid. And like HOKA, good growth across channels wholesale, up 15%, DTC up 11%. And internationally, UGG saw a 20% jump. International is now 39% of UGG's global sales. US grew 9%.
UGG just has that crazy universal appeal, doesn't it?
It really does. Comes down to those iconic designs, that authentic vibe. Management highlighted the fastest grower styles like the Tasman, the Ultra Mini, Lamal, Dissette, Gold Star Clog.
Right, you see those everywhere.
Exactly. And they share traits, right? Recognizable look, increasingly seen as year-round wear, catching on globally, and interestingly resonating more with guys.
Ah, the male consumer focus. That feels like a big untapped area for UG.
Huge opportunity, and they're actively pushing it. They mentioned the Post Malone campaign, collaborations like with Ree Cooper, using athletes and celebs, specific retail things like a Selfridges pop-up, and they even called out strong men's spring sales in China in Q4.
That connects to another thing they mentioned, the 365 opportunity.
Yeah.
Making UGG year-round.
Right. That's about building out the shoulder seasons Q1 and Q4, spring and summer, basically. Right now, those only account for about 25% of UGG's revenue. They want UGGs to be something you desire and buy all year, not just when it's cold.
Okay. Now, they did mention a dip in UGG's DTC sales in Q4. What was behind that? Was demand falling off?
No, actually the opposite, according to management. It was mainly because they just didn't have enough of the really hot styles available.
They sold out?
Basically, yeah. Sell-through earlier in the year was so strong, they ran low on key inventory. So it wasn't a demand problem, it was an availability problem, which, kind of underscores how strong demand actually is.
And probably helps their margins if they're not overstocked, that scarcity model.
Exactly. It helps maintain that brand heat and pricing power.
So UGG still looking really resilient, lots of growth angles, international, men's, year-round products.
Definitely. Especially internationally, that's where they see the biggest long-term growth potential.
Okay, let's zoom out to the company overall. Financial health. How did the balance sheet look at year-end?
Exceptionally strong. Finished FY25 with $1.9 billion in cash.
Wow, almost $2 billion in cash.
And zero outstanding debt. They've been cranking out free cash flow, too, over $900 million for 2 years running. And their ROIC, return on invested capital, is very healthy, over 35%.
And with all that cash, they're returning some to shareholders. Buybacks.
They are, yes. They bought back $567 million worth of stock in FY25 and another $84 million just in the first part of Q1 FY26. But the really big news here was the huge increase in their buyback authorization.
How huge are we after?
They added another $2.25 billion to it, brings the total authorization up to $2.5 billion.
$2.5 billion
Yeah.
for buybacks. On a company their size, that's got to be over 10% of their market cap, right?
It is, yeah. It's a massive authorization.
What does that signal to you?
It's a huge vote of confidence, right? From the board, from management, signals they think the stock is undervalued, they believe in the future plan, and it gives them enormous flexibility to buy back shares opportunistically. That can definitely help support the stock price, especially when things feel uncertain.
Speaking of uncertain, they didn't give formal guidance for fiscal 26, did they? Because of the tariffs and stuff.
Correct. No formal outlook, too much uncertainty with macro conditions and trade policy. But they did share a sort of framework based on what they were aiming for before the whole tariff thing blew up.
Okay, what did that pre-tariff aspiration look like?
Well, in that scenario, they'd expect HOKA to keep being the faster grower targeting mid-teen growth.
Okay.
UGG would be expected to grow mid-single digits, international growth faster than U.S. for both. And wholesale probably growing faster than DTC, especially for HOKA, as they use that awareness to expand distribution.
Right, leaning into partners.
They also mentioned their order book looks healthy so far, but, the full tariff impact on future orders is still TBD.
So, assuming they hit something close to that growth framework, what about the operating lines, margins, costs?
Yeah, gross margin is expected to come down from that record 57.9% in FY25. The headwinds are pretty clear. Those tariffs, probably higher promotions compared to last year's low levels, costs for better materials, and higher ocean freight rates, at least in the first half. The price hikes and cost sharing should help offset some of that, but they expect a net decline.
And SG&A, selling general admin costs. Are they cutting back there?
No, actually. They plan to keep the dollar spend pretty much intact. They're prioritizing investing in the brands, in talent.
Investing through the headwinds.
Exactly. Management basically said, look, this might mean SG&A grows a bit faster than revenue short term, pushes the percentage up slightly, but they see it as a strategic choice, using their financial strength to build for the long haul, gain an advantage.
Okay, and CapEx?
Expected around $120 million to $130 million for the year.
Got it. And they did give specifics for Q1, the quarter they're in now.
Yes, Q1 specifics were provided, expecting revenue between $890 million and $910 million.
Okay.
HOKA growth, at least low double digits. UGG growth, at least mid-single digits.
And profitability for Q1?
Gross margin expected down about 250 basis points compared to last year's Q1. That's driven by freight costs, more promotions, and that channel mix shift towards wholesale.
Right.
SG&A expected to tick up slightly faster than revenue. All that leads to an expected diluted EPS between $0.62 and 67 cents for Q1. That compares to $0.75 last year.
And there was a really important footnote on that Q1 outlook, wasn't there, about the timing?
Yes, crucial point. That Q1 outlook includes the hit from tariffs, but it does not include any benefit yet from the mitigation plans, price increases, the cost sharing. Those kick in later. So Q1 basically takes the full tariff punch before the countermeasures start helping.
Got it. So Q1 might look rougher before potential improvement later.
Yeah.
Anything else? Oh, leadership change.
Yeah, just a quick note, board chair succession. Cindy Davis is taking over as the new chair, succeeding Mike Devine, who's retiring. Standard transition stuff.
Okay, so let's pull back, put this all in context for you, the listener. Deckers had a great year, clear momentum, but now they're facing this, significant external challenge with tariffs.
Right. And what stands out is how their setup might help them navigate it. You've got two strong, distinct brands, HOKA and UGG, hitting different markets. That diversification helps. Plus, their operating model seems flexible, and crucially, that super strong balance sheet. It puts them in a better position, arguably, than peers who might be less diversified or, financially weaker.
That scarcity model they seem to run, keeping inventory tight, that feels key to holding on to those strong gross margins, even with cost pressures, right?
Absolutely. It helps maintain pricing power, keeps the brands feeling desirable. And looking forward, that emphasis on international growth for both HOKA and UGG, that's clearly where they see a huge runway. Still lots of room to grow outside their core markets.
And you can't ignore that massive share buyback authorization, $2.5 billion. It's a huge signal of internal confidence, and it's real potential support for the stock, especially if the market gets choppy.
Yeah, and their choice to keep investing in SG&A and the brands and people, even with headwinds, that's a long-term play. They can afford to do it because they're financially strong, unlike maybe some competitors who might have to pull back.
So bottom line, the framework suggests growth can continue, especially overseas. But the big questions for FY26 are definitely around that tariff impact and how consumers react if prices do go up.
Which leads us nicely into our This Is Not Financial Advice segment.
Yes, and let's be crystal clear here. Everything we talk about now is purely for illustration, for entertainment. It is absolutely not investment advice. Please do your own research. Talk to a qualified financial professional before making any investment decisions.
Okay, disclaimer firmly stated. So here's an outrageous but plausible trade idea stemming directly from this deep dive.
Lay it on us.
How about considering a paired trade? Going long Deckers, stock ticker DDC, and at the same time going short a basket of smaller, maybe less diversified footwear or apparel brands with similar market caps.
Okay, long Deckers, short a basket of weaker peers. What's the thinking?
The rationale is basically a bet on relative strength. You're betting that Deckers is just better positioned to handle this environment. You've got HOKA's growth runway, UGG's resilience, plus those new initiatives like 365.
Right.
Plus, crucially, their sourcing is mostly outside China. They have that fortress balance sheet, $1.9 billion cash, that huge $2.5 billion buyback cushion, and a proven operating model. That gives them a serious edge, we think, over peers who might be heavily exposed to China tariffs, have weaker balance sheets, or rely too much on just one thing.
So you're betting Deckers can navigate the storm better than others, absorb the hits, keep investing, maybe even take share.
Essentially, yeah. You're playing the difference in resilience and financial firepower in what looks like a tough year for the sector.
Interesting. Okay, so just to wrap things up, fiscal 25 for Deckers, unquestionably record-setting, great execution, much stronger financial footing.
Yep.
Fiscal 26 definitely brings uncertainty, mainly from trade policy and the costs involved, but management seems confident in their long-term game plan for HOKA and UGG, and they're backing it up with that financial strength and that very significant commitment to shareholder returns via the buyback.
And again, this whole discussion is based on the earnings call. It's not financial advice.
But it does leave you with something to think about. That $2.5 billion buyback plan, over 10% of their market cap. How does seeing a company make such an aggressive capital allocation move, especially now, influence how you might evaluate other companies with strong balance sheets in these uncertain times?
Does it maybe shift your perspective on valuing growth versus direct shareholder returns?
Something to mull over as you keep exploring these themes.
Yeah.